There are two ways to become a Subway franchisee. The first way is to buy a location from an existing franchisee. The second way is to build a new location. So what does it take to build one of these new locations? We're going to take a look at the cost involved. The cost to build a new franchise location in Subway, according to the franchise disclosure documents, is estimated to be between $150,000 and $328,000. The total cost of $150,000 to $328,000 can be broken down into startup costs, build costs, and opening costs. The startup costs that we'll cover include the franchise fee, insurance, training, and just some of the things that you'll have to pay for before you even get started building. Next up, we have the build costs, which can be broken down into real property, leasehold improvements, equipment leases, security systems, freight charges, and outside signage. These are all the things that take an existing piece of real estate and turn it into something that looks like a Subway. Last, we have opening costs, or what could be considered pre-opening costs, things like opening inventory, having the food available to sell to customers, supplies, general grand opening advertising. So you want to tell people that you're now open, and then additional funds just to pay people, pay employees, pay suppliers, and pay for the other costs involved in operating a restaurant. Now that we've covered the cost to build a Subway, we're going to focus on buying a Subway and really even buying any restaurant. The first thing that we'll start with is store level EBITDA. That is the cash that is generated from operating the store, not counting anybody that works outside of the store. Next, you're going to subtract out all above store costs. These are things like accounting, cost to process payroll, or other employees that work outside of the store. After subtracting above store costs, you now have corporate EBITDA, which gives you the EBITDA that a new buyer is going to expect. Next, you'll multiply that EBITDA by a valuation multiple. Many times in Subway, you'll look at paying anywhere from 2 to 4 times EBITDA, and that'll give you the business valuation or the price that you should expect to pay for the business. So we're going to look at a couple different Subways that are actually currently for sale across the country. First up in Ohio, we've got asking price of $175,000. The first thing I do when I look at these listings is I look at revenue. So $400,000 looks like it's a decent revenue Subway. EBITDA of $49,000, so greater than 10% EBITDA. And at $175,000, we're looking at between a 3 and a 4 multiple. So probably towards the high end of the range. Let's see what else they say about it. Lease location, 8 employees. Everything's included in the asking price. That's typical in a restaurant. If you're buying a restaurant, you need everything that comes with it. The only thing that's not always standard is inventory and cash on hand. So if you can negotiate those two things as a part of the purchase price, you're in a better spot. You also have to take on less working capital. So anyways, 400 in revenue, 175 asking price, 3 to 4 multiple. Next up in Illinois, gross revenue of 275, so much lower. Asking price of 135,000. And let's see if we see cash flow. Nope, no cash flow. So a 2,000 square foot Subway, that's pretty big. No cash flow. So they're asking 135. Even if, let's say they did a 10% margin on the 275, that's 27,000. They're asking more than a 4 multiple, but once again, we don't know the cash flow here, so probably not a good deal. South Carolina, man, this one's cheap. So we see 274 in revenue, once again, pretty low. Cash flows around 10%, and they're looking at just shy of 4 times EBITDA, 4 times cash flow. Next up, another one in South Carolina, gross revenue 238, cash flows 48. So notice all the ones we've seen so far, about 10% cash flow of revenue. This one is dramatically higher, so I would be fearful that this cash flow is overstated. At almost 50,000 in revenue, they're asking for just shy of 4 times cash flow. Like I said, this would be something you would want to dig into pretty closely. My guess is there's an owner operator in this business that is working quite a bit and is going to be downside to your cash flow if you buy it and have somebody else manage it. Last up, pulled one here in Broward County, so South Florida, $242,000 in revenue, cash flow of 52. Once again, quite a bit higher cash flow based on the revenue. Asking price is 80,000. So either they just really want to get rid of it, it has negative trends, or they realize that that 52,000 is not the real cash flow. So let's just say it was 24. They're asking kind of just shy of 4 times cash flow, which is similar to a lot of the other transactions that we saw. Next, we have a financial model to look how we would finance this business. In this example, we're going to use the SBA. For the SBA, you have to put about 10% down, usually on average. So go ahead and enter in the cash flow. So this was one of the businesses we just looked at with almost $50,000 in cash flow. They were asking $175,000. I figure that we can negotiate. Nobody's expecting to get full asking price in this market. So we'll say $150,000 will be our offer price. So we'll get this Subway business at 3 times. So now here you're going to flow through. There will be some transaction costs, some SBA fees if you go through the SBA. So we're going to figure that our all-in cost is going to be $158,000. On that $158,000, we are going to get 90% of that with debt and 10% with equity. So you're going to have to bring $15,000 in equity to the table to close on this deal that is $158,000. So next up, we're going to look at the P&L. We don't know all the stats here, but I entered in gross revenue, just a little bit over $400,000, assuming that cost of sales is going to be about 30%. And ultimately getting down to net income. In this case, we're just assuming that net income and EBITDA are the same. The business doesn't have any interest expense or depreciation currently. So we've got a 50,000 EBITDA business, which is about 12% EBITDA margin. It's probably reasonable for a Subway at this level. Our debt service, so our debt service payment is going to be $22,463 every year. And our cash flow after debt service, so what will you actually make if you put debt on this business? You will clear $27,000 a year. So a pretty small total amount. So as you can see, if you really wanted to buy a Subway franchise and make it into anything, you would have to own multiple locations. Just a comment here on debt service coverage. So this is something that SBA is going to look at. Other lenders will look at it for bigger deals as well. But SBA will look for a ratio over 1.5. So typically, if you've got a deal that trades anywhere really under 4.5 times EBITDA, you are going to clear on debt service. So there you have it. That's what it looks like to finance a Subway location. Thanks for watching. Drop a comment below if I can answer any other questions for you.